Wall Street set to open up sharply lower, extending Friday's sell-off. That was sparked by the weaker-than-expected jobs report, raising worries the economy may be headed for a recession, and the Fed could have waited too long to start cutting interest rates.
$2.9 trillion wiped out. Global stock markets have crashed drastically, sending shockwaves worldwide. Investors are scrambling, governments are on high alert, and the world is holding its breath. This sudden downturn, sparked by a confluence of alarming economic data from the U.S. and mounting fears of a looming recession, has caught many off guard. The air is thick with uncertainty as the ripple effects of this financial earthquake continue to unfold.
Now you can see tech stocks on the NASDAQ, they were most affected, down by 2.43%. So this is at the close on Friday. The S&P 500 is the broader market there. It was down by 1.84%, but none of this was actually helped.
Friday, August the 2nd, saw major losses on Wall Street as U.S. equities fell and U.S. Treasury yields sank to multi-month lows. This fall came after a disappointing employment report that raised questions about the U.S. Federal Reserve's too gradual reduction of important interest rates, maybe resulting in a more severe economic crisis.
The US employment report was released Friday night our time. So the US unemployment rate, it jumped to 4.3% from 4.1% previously.
Downbeat expectations from Amazon and Intel put pressure on the already high valuations of big tech companies. This accelerated the sell-off and sent the NASDAQ Composite Index, which is tech-heavy, into correcting range. The dismal employment numbers stoked worries among traders that the U.S. was headed towards a recession. Closing 10% or more below the prior record high marks an index or stock in correction. Heading for its worst day since 2022, the S&P 500 has fallen 2.5% by midday, marking its first consecutive loss of over 1%. Since April from its July peak, the NASDAQ fell almost 10%. As the worldwide stock sell-off returned to Wall Street, this fell as well. Shockwaves were sent through the markets after a report showed U.S. companies hired noticeably less than expected last month. This report tracked a sequence of less than expected economic statistics from the previous day, including a major drop in U.S. manufacturing output, which has been significantly influenced by rising interest rates. The most recent employment data revealed that July's additions of just 114,000 new U.S. jobs fell short of projections. Furthermore, the jobless rate shockingly increased for the fourth straight month to 4.3%, which raises questions regarding a slowing down economy. This followed Thursday's statistics showing that U.S. manufacturing activity fell the most in July in 8 months. Federal Reserve officials signaled earlier in the week that rates would be lowered in September, and traders raised their expectations on policy easing, given the poor economic data. Since June 5th, the S&P 500 reached its lowest level. Likewise, both the blue-chip Dow and the S&P 500 were en route for their most notable two-day swings in almost 2 years. The Federal Reserve is under more pressure to move forcefully as the economic terrain gets more hazy. The dismal jobs data highlights the difficulties the U.S. economy is experiencing. Slower hiring and increasing unemployment point to possible stalling of development. A major contributor to market growth in recent years, the tech industry has suffered especially when investors reevaluate the high values of these companies in view of the general economic downturn. The sell-off in the larger market shows investors mounting concern about the course of the U.S. economy. Under great examination, the Federal Reserve's next action is under observation by market players, who are closely looking for any indication of more severe economic downturn that would call for more forceful policy response. The intricacy of the matter is increased by the continuous trade disputes and global economic uncertainty, which makes Fed navigation of the road forward challenging. Investors are looking for safe havens in this volatile environment. U.S. Treasury rates are reaching multi-month lows as demand for less dangerous assets rises. The response of the bond market points to investors preparing for a more marked economic downturn and possible Federal Reserve rate cuts. Based on a Reuters study of LSEG data, averaged roughly every 2 years, the stock market index has slid into the correction zone 24 times over the past 44 years. Notwithstanding this, the NASDAQ is up by 12% year to date, and the S&P 500, albeit down roughly 6% from its top, is also up by 12% for the year. Investors' rising trepidation over the very valuable tech firms that have propelled much of the year's market gains shows in the recent NASDAQ dip. Artificial intelligence, or AI, has driven these equities, but poor performance of firms like Tesla and Alphabet last month raises questions over their lofty valuations. These less-than-expected outcomes have also caused anxiety of a more general economic downturn. Treasury yields dropped drastically in the bond market as traders changed their projections on the possible Federal Reserve rate reduction. From 3.98% late Thursday and from 4.7% in April, the yield on the 10-year Treasury sank to 3.81%. This shows growing need for safer assets as economic uncertainty grows. Slowness in online sales growth in the second quarter caused Amazon.com to drop 9%. Buyers chose less expensive substitutes. After projecting lower than expected third quarter income and saying it would discontinue its dividend starting in the fourth quarter, Intel faced a startling 27% decline. Intel also announced a $1.6 billion quarterly deficit and intentions to reduce more than 15% of its staff. Other semiconductor stocks match this, with ARM Holdings and Micron Technology dropping almost 7% each, while Nvidia and Broadcom both lost 2%. Reaching a 3-month low, the Philadelphia SE Semiconductor Index marked its largest 2-day drop since March 2020. Apple bucked the trend among the larger market downturn by increasing 2.3% following better-than-expected third-quarter iPhone sales and projecting even more gains based on artificial intelligence developments. By comparison, missing second-quarter earnings projections caused Chevron Corp to drop 3.5%. Concerned about recession, major U.S. banks also fell for the second straight day. The S&P 500 Financials and Banks indexes dropped 3% and 4.7% respectively. After projecting lower-than-expected current quarter results, Snap Inc. suffered a sharp 24.7% drop. Slumping 4%, the small-cap Russell 2000 index reached a nearly 1-month low and geared up for its largest 2-day decline since June 2022. Rising over its long-term average of 20 points, Wall Street's fear gauge, the VIX index, reached its highest level since last March. The volatility of the market reflects the complicated interactions among elements affecting investor mood. Though it has been a major driver of market performance, the tech industry is under increasing scrutiny as worries about economic slowdown and overvaluation develop. The poor results of big businesses including Intel, Alphabet, and Tesla highlight the difficulties still to come. As traders expect more forceful rate reduction by the Federal Reserve, the fall in Treasury yields points to a change towards safer investments. This action in the bond market draws attention to the general fears on the state of the economy and the possibility of a more severe recession. Among otherwise volatile markets, Apple's strong performance is unique as a rare bright spot. Driven by artificial intelligence advancements, the company's better-than-expected iPhone sales and bullish expectations point to certain IT behemoths perhaps still finding chances for expansion despite more general market headwinds. Still, the challenges of other internet companies and big banks highlight general issues. While the declining small-cap Russell 2000 index points to more general market trouble, the financial industry's substantial losses reflect deepening economic worries. The increase in the VIX index, Wall Street's gauge of market volatility and fear, highlights still more the uncertainty. The VIX crossing its long-term average indicates that investors are growing more concerned about the direction of the market and the possibility of more falls. With the Stoxx 600 index finishing 2.7% lower, European stocks kept their declining trend most significantly in almost a year. U.S. job statistics drove investors to flee into defensive equities as they heightened the sell-off in tech shares. Including Sanofi SA and AstraZeneca plc, utilities and drugs beat the wider market. Falling 23.92 points or 2.2% to 1,063.88, emerging market equities also suffered. At 554.93, MSCI's broadest index of Asia-Pacific shares outside of Japan closed 2.27% lower. Tokyo led the losses in Asia, where markets closed before the U.S. job data was published. Driven by a higher yen that adversely affected Japan's main export industry, the Nikkei 225 dropped 5.8%, its largest dramatic decline since the start of the epidemic 4 years ago. The Bank of Japan's choice to raise interest rates for just the second time in 17 years, combined with rumors of another increase, helped the yen to reach its highest level since March. This action taxed Japanese stocks much more. Elsewise in Asia, Taipei plummeted more than 4%. Hong Kong and Sydney sank by more than 2%. Seoul dropped over 3%. Also noted were losses in Shanghai, Mumbai, and Singapore. Friday's gold prices jumped to their highest level in more than 2 weeks as Treasury rates and the U.S. currency fell after the dismal U.S. employment report. The numbers inspired expectations for Federal Reserve rate cuts this year. Spot gold increased over 1% to $2,472.59, barely $11 shy of the record top of $2,483.60 attained on July 17th. Rising 1.4%, U.S. gold futures came to $2,516.50. Driven by growing safe haven demand amid Middle East tensions and rate cut predictions, gold has risen 3.2% thus far this week, positioned for its biggest week since April. Friday's crude oil price drop was more than $2, following a fourth consecutive weekly drop. The poor U.S. employment statistics affected market mood, and worries about a slowing Chinese economy further tested investor confidence. U.S. West Texas Intermediate crude futures were down $2.90, or 3.8%, at $73.41. Brent crude futures lost $2.65, or 3.33%, to $76.87 a barrel. During the period, U.S. crude futures dropped nearly $3 per barrel. The instability of the worldwide stock market reflects general investor fear. The U.S. employment report aggravates the drop in European stocks, so highlighting the connectivity of world financial markets. Utilities and drugs were among the defensive industries that offered some respite, but generally the attitude is still wary. The large losses in Japan's Nikkei 225 in Asia draw attention to how exchange rates affect economies focused on exports. Supported by Bank of Japan's interest rate increases, the stronger yen poses a difficulty for Japanese exporters, which helps to explain the significant drop in the market. Other Asian markets felt the impact as well, significant losses across several indexes. The rise in gold prices points to a movement towards safe haven assets as investors search for consistency in the middle of economic turmoil. The prospect of Federal Reserve rate reduction and geopolitical concerns, especially in the Middle East, have added to the metal's attractiveness. The great performance of gold futures points to investors getting ready for possible volatility in other asset groups. The price decline of crude oil underscores worries about world demand, especially in view of the meager U.S. and China growth reports. The continuous drop in oil prices indicates that investors are cautious about a possible slowing down in economic activity, so lowering demand for energy. The steady drop in crude prices emphasizes the precarious situation of world economic development. Friday's worldwide mood soured as dismal economic news caused a steep plunge in the U.S. market overnight. The most recent data revealed a decline in manufacturing growth and an increase in weekly jobless claims, which aroused concerns on the degree of the economic recovery. The largest increase since August 2023 and above the first estimate of 236,000, weekly unemployment claims jumped to 249,000 for the week ending July 27th. Concurrently, the ISM Manufacturing Index, which gauges U.S. manufacturing activity, dropped to 46.8%, signifying economic decline. This was worse than the anticipated 48.2%, which stoked more recession worries and questions about the Federal Reserve's delayed rate-lowering action. In its July meeting, the U.S. Federal Reserve had maintained important rates unaltered, yet in September, it made hints about a likely rate reduction. The abrupt decline in GDP data has stoked recession worries in the U.S. and caused market volatility on the possible influence. As Dr. V.K. Vijaykumar, Chief Investment Strategist at GeoJit Financial Services, points out, the significant decline in the U.S. 10-year bond yield to 3.95% highlights this increasing fear. By comparison, the BSE Sensex has been on an amazing surge, rising over 1,800 points in the last 6 trading sessions and firstly crossing the 82,000 mark on Thursday. The Nifty also reached unprecedented heights, topping the 25,000 summit and breaking records 3 days running. Still, money entering the market has fueled more of this movement than solid foundations. As Dr. V.K. Vijaykumar said that without basic support, the rise might not last, implying that some profit booking, especially in mid and small cap markets, could be wise. Benchmark indices have shown tenacity within the present bull run in the Indian stock markets, recovering rather than cleverly following unexpected declines. Investors who acquired shares during these declines have profited over the last 18 months. As indicated by Kranti, it could thus be prudent to search for purchasing possibilities during such situations. Still, the latest behavior of the market suggests possible volatility. After Thursday's gapped-up opening, repeated efforts to breach the 24,970 mark on the Nifty point to distribution. Anand James, Chief Market Strategist at GeoJit Financial Services, predicts a more drop towards 24,750 and 24,600 should the index fall short of 24,850. On the other hand, a pullback above 24,850 would see the Nifty aiming once more for the 25,192 to 25,800 trajectory. So that is all the time we had today, folks. Hope you enjoyed this video. Do not forget to subscribe to our channel and do hit the bell icon on your way out. See you all next time.